Hey, everybody. Welcome to Messy in the Middle. And today we have Jeremy Patterson with Fairway Mortgage. Hey, Jeremy.
Hey, Jefi. Thanks for having me.
Of course, we need you right now with all these shifts in the market. We need really great, strong lenders, and you are my number one. So everybody, Jeremy's based out of San Diego, California, and he's been in the business for 18 years. One of many things that I love about Jeremy is that he has a super unique why. Do you want to share a little bit about that?
Yeah. So when I first got into this business, I thought, man, I could definitely do that simply because, my first experience was not so great, right? So that was my first introduction and why I wanted to get in this industry. And the second reason is kind of finance and safety. So, one of the things that a lot of people don't know about me and that I don't really share often is that I had two daughters that passed away really young to a neurological disease. And one of the things that was always my safety net was essentially my home, right? I could always come to my home. I could always count on it. As my first daughter passed away and my second daughter was really sick, it was still a home, right? And what I learned from that, among many, many other things in life, was financial literacy was probably one of the most important things that I dealt with. So going through that, one, knowing how important a home is, but two, understanding financial literacy and how best to protect your family is one of the most important things we can do. And I think that's all through not only home ownership, but education and really understanding it. So that's my why, is helping people really understand why home ownership should fit within their entire financial portfolio and how best to educate themselves to protect their family for generations to come.
Yes. And I will chime in on that. Yeah, it's pretty amazing, huh, Ed? When I send clients to Jeremy and they sit down and they have their first consultation, 99% of the time I get a phone call. And the phone call is, oh my God, this is like so much bigger than buying a house. This is what it looks like in 5 years, 10 years, 20 years, wealth building. So to have somebody on your team that does that is just amazing. So I want to thank you too from the bottom of my heart.
Yeah, no problem. Thank you.
Yeah. All right. Well, go ahead, Ed. Sorry.
No, I was going to say that's a powerful line. Thank you for sharing that.
Yeah, you're welcome. And I think, man, I love it. I love helping people understand. Especially first time home buyers where they don't, even people that bought 3 or 4 homes, they go through our process and go, I never knew that. I wish I would have known that when I was 20. So it's a lot of fun.
Yeah, it's good. Well, talking about getting creative in the loan department, do you want to dive into what a 2-1 buy down loan is and why you think it's important?
Yeah, right. It's 2-1 buy downs are something that were used a while ago, and it's definitely a little bit of a different process. So everybody kind of understands a normal buy down, right? If you go in and you go into any type of lender right now, they're essentially quoting interest rates with paying a 1-point discount fee or a prepaid interest or whatever they want to call it, but they're buying down interest rates. And what you're doing is you're essentially prepaying interest to buy an interest rate down to a certain point, and it's a long-term buy down. Now, we do have something called short-term buy downs, which is what a 2-1 buy down is. Now, I'm going to try to keep it as simple as possible because I think it's a really great tool for sellers, a fantastic tool for real estate agents. And I think buyers in the right situation, it works too. But a 2-1 buy down is simply what it means. It's a 30-year fixed mortgage, and it's a temporary buy down so that, let's say your 30-year fixed mortgage is 5.5%. Okay. For the first year, the interest rate would be 3.5%. For the second year, the interest rate would be 4.5%. And then for the third year, as well as through the remaining term, it would be 5.5%. And that's why they call it a 2-1 buy down. It doesn't
okay, so let me make sure I get this because I just want to slow it down a little bit.
Sure, please.
So we're in a rising interest rate market and people are having affordability issues, right? And so this is a way to lower the cost for the buyer in the first year and the second year. Am I getting the concept correctly?
It is, yeah. That's exactly the concept. It lowers the payment for the first year or the second year, right? Which is the reason that a lot of people aren't buying homes right now is because interest rates have jumped up so quickly. Something that we've never seen it jump so fast before.
Yeah.
Yeah. And then there's another layer to that too, Ed, that Jeremy explained to me is that if a seller, in lieu of doing a price reduction, they help facilitate that buy down, the cost is far less than doing a price reduction. So it's like an old school credit to the buy side to get a creative way to get the most amount for the seller. So it's a win-win.
So what happened? Again, I'm still struggling with the concept here a little bit. So
okay.
what happens to that interest? So is that you're buying it down through points? Is that what's happening, or is it negatively amortized on the back end?
No, you're actually paying it with interest deductions. So think of it like a separate account just for the interest payment. So your actual note is for an entire 30-year fixed period at 5.5%.
Gotcha.
What winds up happening is you take the extra interest that isn't being paid on the first year and the second year, putting it into kind of an escrow account of sorts. And every time that the client makes a payment, they're pulling interest from that escrow account to complete the payment part.
Okay.
That's where the buy down, the buy down funds go into that account, correct?
Yeah, the interest itself goes, because when they're buying it down, they're not paying a point technically. They're simply prepaying the interest.
Gotcha. Okay, that makes sense. And again, one of the reasons I'm struggling with this is y'all are a little bit ahead of us on the curve on affordability and slowdown. Mm-hmm. And it's showing up, and it showed up in your market about 6 weeks ago, and it's just starting to show up here. So these techniques are going to become more valuable for us.
Yeah, and I think understanding something a little bit more unique about this is going to be really important because look, a $20,000 price reduction is likely not going to get a home buyer into that home if you're a seller, right? Like that's just not going to be enough. But if I can show a client how to save $1,000 a month for the first year, $500 for the second year, that's significant for them to make the decision to move into a home, right? So it really becomes valuable for a seller because a deduction of maybe $50,000, $80,000 would have a similar impact on payment, but then your seller is paying a significant cost of being able to do that, right? And I think it's important to understand it's something unique that you can do because kind of the ongoing idea right now is, I'm sure you guys have heard this, right? Marry the home, date the rate. Have you guys kind of heard that?
I love that, but no, I haven't. And I just had a conversation with a sweet little buyer this morning that was saying, look, I think I'm good buying right now at 6% as long as I know that eventually I'll be able to refi. And, that's a question we have for you down the road here, but do you feel like that's, how many years are we going to be into this?
Yeah, I think that's a really hard question to answer. I think that there's a lot of data out there as far as what happens in recession. There's a lot of data out there that kind of talks about what the Federal Reserve does with interest rates in the middle of recession, right? So you can look back at every single recession and realize that Federal Reserve has always raised rates in the beginning of a recession. That's because typically, we're not feeling the impact of them raising rates until you're in recession, which is pretty simply 2 quarters of negative GDP growth. Now, that second quarter, we believe, is ended now, right? The second quarter's up. The data hasn't come out. Expectation was that it was going to be even or slightly up, but I have a feeling it's going to be negative, and that puts us into technically a recession, which it's crazy. A lot of people think that's bad, but it's not a bad thing for housing. Housing prices go up in recession, not down, except for 2008, which I don't know if I'd say it's a recession. That was a mortgage meltdown, right? We did some really dumb things in the mortgage industry to cause that.
Right.
So,
but a lot of people, a lot of the consumers, Jeremy, they have like flashbacks, PTSD to 2008, and they didn't live, they didn't live through the previous recession, so they keep pulling back to that piece, which is another great things to educate your clients on, is that was a mortgage issue, not a recession issue.
Yeah. Well, and Jeremy, I think you bring up a really good point, which is of all the recessions since 1980, I think there were 6 of them, only 2 had negative pricing effects on housing. So housing quite often will go up during that period of time. It just depends, and and it's going to be more of an old school one that we're seeing, not the mortgage meltdown that we had in 2008.
Yeah, and we could spend a whole episode on 2008 compared to today, right? There is so many different factors that we could talk about it for an hour. And typically I do with clients, right? My job is not doing mortgages. It's serving people and helping people make a great decision. I don't care what the decision is. I think that it's more important to give them the data. And I have these conversations with every client, even though I'm not selling real estate, because I believe that, like you said, Jefi, people are getting it wrong. They're just they're thinking about what mom and dad went through, right? Or they're thinking about all the problems that they couldn't refinance. Just like doing ARMs today, right? Like an ARM isn't necessarily a bad product if it's the right product, right? Like it just depends.
So before we go into other solutions, I wouldn't mind going big picture a little bit in terms of what you've been seeing. Again, because you guys are tracking, maybe 6 weeks ahead of us. What have you seen in terms of loan applications, people's ability to qualify? How have things changed, say, since May 1st?
Yeah, I think the most difficult thing over the last 2 or 3 weeks, we've seen referrals and leads really kind of fall off, which is typically we track that really, really closely. That's kind of a number we watch, and we're kind of down about half.
Wow.
But the harder things are, all the work that we've put into helping people get pre-approved for homes, right? That was where things really shut off. Here in San Diego, right, a difference of 1% interest rate is a huge difference in payment.
Yeah.
And we really saw those clients go from looking at homes to going, we're going to wait and see what's going to happen next. And that's been the most painful part because they're poised to buy homes. I don't have a problem with qualification. Right? There's not an affordability issue on our side. It's very rare we run into a client that can't qualify 4 months ago, that qualified 4 months ago, but can't qualify today. It's typically they qualify fine, but just FOMO, right? Fear of missing out and going, man, I remember when rates were this. The problem with that is if 3 months ago you were putting 5% down, I couldn't get you in a home unless you had 50 grand over asking price, right? It wasn't feasible.
Right.
That's the hardest thing for people to recognize. So I don't think it's an affordability issue. I'm not seeing that at all. I'm seeing more of an issue of fear of what people are hearing, what they're seeing, inflation, right? Another $1,200 a month in spending, which out here in California, that's about what we're seeing. And then on top of that, you're asking them to pay higher interest rates. And it's really hard to tell a consumer, don't worry about it, forget it, just spend the money. $2,400 a month in difference. It's big.
Yeah, it's big. It
is big. And this is rolling your way here, Ed. So this is good content to share with your people so they don't miss out in the next 30 days. Because that's about what I think you have, don't you? Based on what you have of inventory?
Yeah, I think we've been tracking about 30 days behind you. It's interesting, Jeremy. We, because Jefi and I, we track our numbers every week in terms of absorption and what's going on in our micro markets. And we just crossed over to 1 month of supply today. Jefi did that about 30 days ago, and I think you're at 1.2 months today.
Yep.
We track it every Wednesday for the, also for the show. But what I tell my clients is, equilibrium 6 months. So it's still a very, very healthy market. It's just not pants on fire hot. It's hot. And so it's resetting expectations. In fact, I brought a listing on today. And if it would have hit in May, I would already have, 15 to 20 showings scheduled. I've got one. Now it's a very interested buyer. It only takes one, but it's a different game. So it's going to be interesting as this rolls out and having tools, which is, I think, what brings us to one of the other arrows in your quiver, which, made me want to start rocking my 80s mustache again, which is the reverse mortgage. Tom Selleck's favorite product, baby.
Man, if I could grow that mustache and yes.
So I want to hear what you've got to say about that, because I'm trying to figure out how I'm going to communicate this to my clients. So take it away on the home equity conversion mortgage. I think is the real term, right?
Yeah, so home equity conversion mortgage is pretty much like a cousin of a reverse. Yes, it is reverse, but there's been some really great changes to protect consumers. And I think the thing that a lot of people don't realize is how valuable a reverse mortgage can be to grow wealth. And you think it's the other way around, right? Like most people, when you think of reverse mortgage, you think of needs-based. Look, I don't need a reverse mortgage. I have plenty of money and I have equity. Mm-hmm. Right? Like, okay, you're good. Well, the reality of that is some of my most affluent clients are doing reverse mortgages for all the other stuff around them, like tax benefit, like growth in the home equity line, access to tax-free money. Like there's a lot of things that go into talking about reverse mortgages that aren't needs-based. It's more of strategic planning. And we work with some of the top, financial planners out here in San Diego that we're having conversations around how do we save our client more money in taxes? How do we, prevent them from getting smacked with a negative 20% in their portfolio currently? But there's so much that goes into it that, we're kind of changing how America does retirement by understanding there's something you can do with your mortgage other than pay it off and have this equity tool that you simply cannot touch unless you take a loan on.
Mm-hmm. Right. So walk us through it.
I was thinking if you had a case study, somebody that you've been working with to do this, and we could dive into maybe one aspect of it a little deeper.
So I've got several, right? And it just depends on the path, whether it comes down to you have a client that wants to refinance or a client that wants to buy a home. So I think in this situation, let's talk about a client that's downsizing.
Okay.
How's that, right?
That'd be great.
That's too big for them currently, right? They're no longer have kids. They're 75. And we're going through this right now with one of our clients. And it's been a lot of fun, a lot of challenge, right? Because a 70-year-old client is a little different than a 30-year-old first-time home buyer. But here's the situation. You pretty much have a client that, owns a home on the coast worth $2.8 million. And they essentially have very little money for the future. They live on a small pension and Social Security. But that's it, right? They don't have a ton of money saved because they did everything in their home. They invested in their home, and that's just the situation. So now that she's in her 70s, she's trying to figure out a way, well, the home needs a ton of work. It needs to be either renovated, done with whatever she wants to do or whatever a new potential buyer wants to do. And now we're talking about, okay, do we want to create liquidity for the future, or do we want to give you access to the equity to let you fix it up to sell it later? And that's kind of a conversation. But the fun part about this is when you look at a reverse mortgage, you have options. So, for example, if she was going to downsize, which is what we're talking with and trying to have her understand. So, say you sell a home at $2.8 million, you move away from the coast, and you find a fantastic home at, say, $1 million, right? Which in San Diego is possible, right, Jefi? I mean, not.
Mm-hmm. Well, $1,055,000, $1,087,000, 1.1, I think is probably. Just because I track my numbers.
Yeah, just because you track your numbers, right?
I love these numbers.
Yeah, so think about it this way. If she's going to make that decision and buy a home, you can actually do a reverse for purchase. And a lot of realtors don't understand you can do that. Okay. Close it as quickly as 17 days. We're one of the few companies in the nation closing in that quick because we're committed to them.
That's cool to know.
Yeah. So it's really unique and rare. So it doesn't really cause any issues on the other side. But just think about the number. So she buys a home at 1.1. She can't really she's going to put down about half. You figure that loan amount on the first for the reverse mortgage will be $500,000. So she's going to have to put down $600,000. Okay. So she sells her $2.8 million home. Let's say she nets $2 million, which is, and she's going to put $600,000 down on the next purchase and live mortgage free.
Right.
Now she can give $1.4 million to her financial planner and protect her for the next 20 years so she has something to live off of.
Right.
Like you can't do that with, anybody listening to this podcast, I dare you, go to the bank, tell them you want to get a loan, you don't want to pay a mortgage, and you can never default. Well, technically you got to pay property tax and insurance, right? And you got to keep the property up. But the idea is there's just no other tool or financial tool you can do that with.
Right.
Pretty cool.
So, I want to make sure I understand this correctly. Yeah. So she has the reverse mortgage, which you can close in 15 days at Fairway.
17, but yes.
17. Okay. She has the money from her sale that she can give to a financial planner. Okay. But she doesn't have to make a house payment.
That is correct.
So So even though she has a $500 or $600,000 loan, that, and I understand that it whittles down her equity, but she
100%.
doesn't have to pay that. She can, right? She
Yeah.
can pay it, but she doesn't have to pay that.
Yeah, so there's a couple really unique things too in that situation. She doesn't have to pay the mortgage, right? She knows that she's going to give up that equity over time, and you can work the numbers backwards. That's a great thing about reverse mortgage. It's all in disclosures. A good reverse mortgage person or home equity, conversion mortgage person will really help you understand the numbers.
Right.
But when you do a purchase and you use a home equity line of credit, how many of your clients right now in that situation are taking a tax deduction?
They're not.
Many, right?
Yeah.
If they're married.
Right.
Yeah.
Right.
But here's the great thing about reverse mortgage on a purchase, because you bought a home with it, if you let that interest accrue, right, all you're doing is adding principal balance, but it's interest. She could technically take money in the future from her $1.4 million she gave to her financial planner and pay the mortgage down as a lump sum.
Got you.
If she does that, you always pay the interest and the mortgage insurance first. So now she would create a huge tax deduction for her if she needed it, if something should come up.
I got you. Okay.
Got it.
Yeah, see, these things are all so intertwined, and it's just it's really it's beautiful because you're leveraging an amazing asset, which is your home, to do something that sets you up for your future. And I can't really speak on it because I don't understand it like you understand it, but it sounds like something I'd like to get to know better.
Yeah.
Well, think about all those empty nesters that we're working with that are downsizing, right? And so here's a tool. So it's worth it. It's worth exploring. That's very cool.
And the hard part with that is people have this bad feeling about reverse, right? Because they remember Tom Selleck, and say, "Hey, do a reverse mortgage," or people losing their homes and their spouses not being able to stay, or like you used to be able to do a reverse mortgage and not put a spouse on it, and then whoever was on the mortgage, if they passed, well, the spouse wasn't protected. Now you're upside down on the property. They don't really allow for that anymore. There are some products, proprietary stuff that will allow for that, but in our normal home equity conversion mortgage that's insured by FHA, that you can't do that. The spouse is protected to where they can live in the home for as long as they want, as long as they live in it. That's the key with reverse. They got to live in it, pay the property taxes, pay the insurance, and keep the property up. If they do those three things, they're fine. They can be there as long as they want.
Yep.
I love that.
Yeah.
So, Ed, you feeling more comfortable with this idea?
I am. I'm ready to jump in the chopper with Magnum. I'm ready to go.
I love it. Yeah.
All right.
Is there anything else?
Is there anything else you want to add to the reverse mortgage before we start wrapping things up?
I do. I got one more thing I want to mention in our scenario, right? I think it's really important to understand. So in those scenarios, right, with a home equity conversion mortgage, you can also set up a home equity line of credit that grows with time, right? So let's say, for example, you have a consumer that is going to put more money down than they expected, or let's say they have a little bit. So let's say, for example, in our situation, she puts more money down. You can create a home equity line of credit that will sit there and be available for whatever the client wants. Now, the value of that home equity line is it doesn't get smaller with time. It actually gets availability-wise bigger. So let's say, for example, she does a $100,000 home equity line. After year one, the availability is no longer 100. It's 106,000. Year two, available 112, right? The home equity line availability grows with time. So if you're younger in the 62, 63 range, you're going to have 20 years of growth. So imagine that as a financial tool. If you could give somebody $200,000 and say, okay, it's going to grow at 5% every year.
Yeah. That's interesting.
That makes sense.
So you can draw on it and it moves. So the one thing that's great about home equity conversion mortgages is they're the best Swiss Army knife because you can move them around to monthly payments. You don't have to refinance. You can just move them. So it gives your financial planner and you a ton of opportunity to really tailor what you're doing fiscally, especially right now. If you retire today, taking a negative 20% off your portfolio. Right.
You don't want to be doing that.
A bad mix. I could show you the way your rate of return would be significantly higher if all you did was not draw on a negative year. You drew from your home equity line. It's crazy. The numbers are crazy.
Yeah,
that's pretty cool.
See, when you say things like that, it makes total sense. My brain goes, of course that makes sense.
Yeah.
So maybe this is for another podcast, but how do we get the word out to people who have that negative vibe or feeling about a reverse mortgage? Like, what do we, I mean, obviously I would send them to you, but like for Ed or anybody in general around the country, how do we start this conversation?
So one, you can't talk about reverse mortgages. You just can't, because as soon as you say reverse mortgage, they go, whoa. I'm not
Swiss Army knife.
Yeah.
Hey, man, I got a Swiss Army knife for you.
Yeah, it is. The reality is, that you always want to talk about home equity conversion mortgages, right? And when they ask about reverse, yes, it is. It's like their cousin, and it is similar.
Yeah.
But the key with it is really saying, look, it's probably one of the best financial tools, and you just have to talk to your loan officers. I think the number one thing you can do is get them to a pro that does home equity conversion mortgages.
Right.
As our business grows, we're going to eventually be a full-time reverse mortgage team.
Wow. Okay.
And the reason for that is because it's such a fantastic tool. 10,000 people are turning 62 a day. 10,000 people.
That's a good number to know.
Right. And do you know how many didn't prepare for retirement?
80%.
Yeah, I was going to say.
Closer to 90. It's so often that I meet with, I have a meeting later today with somebody that just turned 62. They want to retire in this market. It's negative 20%. They have $600,000 in their portfolio. They're going to retire on Social Security pension, very small, and they're going to pull money from their portfolio to do it. Like, that's not enough. What is it going to look like in 20 years? It's not enough. What happens if little Johnny needs something? What do we do? So when you think
Jeremy, you brought up a really good point on it I hadn't thought about, which is, when you set up your retirement and you're pulling from your portfolio, why would you want to be drawing down in negative years? So look at this bucket of equity you have in your home and set that up to be able to pull down when it makes sense to pull down from that.
100%. And you can always pay it back, right? You can pay on a reverse mortgage. So if you don't take on a negative year, you draw from it, your portfolio recovers, you start gaining money, great, pay the mortgage down. Because remember, let's say I paid our mortgage down $20,000 on a reverse mortgage with a home equity line. That $100,000 home equity line now grows by $20,000 for availability. So I don't lose the money. It just goes into the bucket.
Right. You're just transferring.
It's a tool. All you're doing is moving it back and forth. And people don't recognize it as a tool. So as you approach people and talk to them, they're not thinking tool. They're thinking, I don't need that because somebody's going to take my home, which doesn't happen, right? There's safety nets there now. So I would say as a real estate agent, a realtor talking with your consumers, the first thing is to recognize if they're over 62, you need to work with a retirement specialist to make sure they can really help inform your consumer on what works and what doesn't.
Right.
And they got to be able to talk fiscally. Not many loan officers can talk about Roth conversions, down market, sequence of returns, IRAs, tax-free, like all that. They can't talk about it. For me, I love it and I love talking about it, so it fits in my wheelhouse. But if you ask your, loan officer about a, sequence of returns or a Roth conversion or the tax rate, they're going to, most loan officers don't quite get that.
That's why we're friends.
Love it. Love it. Well, Jeremy, I want to close with, again, kind of maybe going big picture just for a second. So, we're in a new environment, and I know your crystal ball is going to be a little fuzzy. Everybody's is. But where do you see, 18 years in the biz, where do you see this kind of going rates-wise? What are you feeling out there? What are you hearing?
Yeah, so I think we're in a really weird time right now because some of the data coming out is showing inflation is slowing a bit. Our expectation 3 weeks ago is the Fed is going to continue to raise interest rates. And I still believe that's in the cards, right? I think the Fed's got to continue to raise interest rates. Now, for your consumers, you got to remember that interest rate doesn't have a direct impact on 30-year fixed mortgages. That's where a lot of people miss it.
Right.
It's the feeling of what's happening in the market, not just the fact they're raising it. It's credit cards, cars, revolving debt, that kind of stuff. So the belief is, rates are going to continue to go to hedge inflation, but it's all going to depend on what that inflationary data is. Inflation keeps going up. Federal Reserve has said they are full on okay with putting us into a recession and slowing down home purchases because they need to control inflation, which imagine being on a fixed income with costs going up 9%. You can't deal with that. It's not possible. Yeah. So my crystal ball shows that, it's rates, if I had to predict, will continue to climb, but I think they're going to soften a little bit and go, okay, we got to take a breath a little bit and figure it out.
Very good.
That will be good.
I would hope so.
Yep. Yep.
Yeah.
Well, we can't thank you enough for coming on and explaining a couple creative solutions, giving your wisdom into business and approach. We really, really appreciate it.
Honored to help.
Absolutely. Everybody needs a friend like Jeremy if they can't have Jeremy himself.
Because I challenge everybody financially.
Smart cookie. I know you do. Sometimes that makes me a little crazy in the head, but I love it. I'm better off financially because of you.
Oh, thank you. It's nice of you,
You're
Jefi.
very
Thank
welcome.
you.
All right, everybody. Thanks for listening to our podcast. Give us a thumbs up if you liked the content. You can watch us on YouTube as well if you want to see our smiling, happy faces. And like and share. Hope to see you guys soon.